Hey everyone, John Henry here, Slingshot Futures Trading Group, SSFTG. One of the easiest ways to mess up an amazing trade is to enter too early or too late. And that's what today's video is going to be covering, is how to time your trades properly. Because it really puts you behind the eight ball, and sometimes taken out just in time to see the trade work out in your favor. We've all been there before. Patience is king in this industry. If you are impatient with your entry and you jump in too soon or too late, you're going to have a bad time. One of my favorite ways to time the market, aside from all the patterns and structure and order flow and everything else, is just using simple, straightforward, cold, hard numbers. You know, me and those good old numbers. What numbers? Well, the morning DP levels that I post every morning on SSFTG.com's website at the morning brief on the top left. Now, these levels can create massive turning points for the market, and I've talked about them several times before, but the big thing that they're doing is they're giving you the probability of the trade and putting the probability in your favor if you're looking to be a contrarian. Now, the reason I say that is because these levels inherently are contrarian in and of themselves. It's looked at this as the assumption that the market will close underneath this level 95% of the time. The market will close underneath this level 85% of the time. The market will close underneath this level 65% of the time. You kind of get the idea. So it's more about probabilities. It's not that each individual level acts as resistance, although they do very frequently. They're incredible support zones of support and resistance. But these allow us the probability. So if I were looking at crude oil as an example, the chart that I have open right now, and the market is perpetually going in a bear trend, and I look at this move to the upside and I say, man, you know, this move to the upside is very strong. I really need to be careful about where I start coming in against this move if I'm looking to continue the bear trend, if I want to be a seller in this bear trend. These levels create major turning points. Right now, this is at a positive 1.5 DP. That means that from settlement, this dashed yellow line, it's moved up a half of a deviation, 1.5 deviations or decision points to the upside, and now we have a major zone of interest at 68 that creates, well, a potential area that has a very high probability of success. By the end of the day, we should close underneath this level. So let's say as an example that the market is trading up at this area, and if I add the bar timer on here, we can see how much time is left on the candle. Go to the B's here, bar timer, there we go. So with the bar timer, this current candle has 4 minutes, 45 seconds left, and the rest of the day, I mean, you're only looking at about 12:15. We've still got another, 2-3 hours until the end of the day for the market. So realistically, if sellers are looking for shortable opportunities and we're sitting in an area that should statistically, in previous moves, based on analysis, should close the market underneath it with a certainty of 85 to 88%, then realistically, if I have a trade setup, as an example, that has a 50% accuracy, a 50-50, or even a 40% accuracy, I have a 40% accurate trade that's setting up in a location that has an incredibly high probability that the market stays underneath it. I'm putting all the wind in my sails. Now, that doesn't mean that I immediately just sell straight on top of a DP level. But when we start coming into those areas, if it lines up with other things, I'm definitely going to be paying attention. On this chart, as an example, we've got the positive 2 DP, and the likelihood that the market will close underneath this by the end of the day is 95%. If the market were migrating around these highs with another 2 or 3 hours left in the day, we've got some previous major structural zones of interest. We've got a previous breakout resistance point coming into retest. A lot of things would suggest that the market should fall there, and it would make a lot of sense to try to structure it in a way that anything underneath that DP level would be a profitable zone. That could be with options, it could be with futures as your break-even point, it could be a lot of different ways, but this is one of my favorite ways to ensure that I've got a lot of wind in my sails. It guarantees nothing because nothing in the market is ever guaranteed, but it does give a lot of benefit or something that you can rely on, that wind in the sails, if you will. So that's going to be something that is always on my list and something that I'm always taking a look at and seeing where are we in relation to these DPs. Are we above the value area that I should be looking for the market to potentially return back? Are we below and I should be looking for the market to bounce? It's a really good way when you stack that on top of other things to create a very, very good, reliable turning point to find some solid entries. That's going to do it for this one. If you have any questions, of course, you can always drop them in the comments below. And if you have a more detailed question that needs some more answering, you can always shoot me an email as well, jhb@ssftg.com. Until the next one, I hope you enjoy, rest up, and we'll see you all then. Thanks.